This is Nightly Business Report with Bill Griffith and Sue Herrera.
Tumultuous week. Stocks dropped sharply. The Dow wipes out its gains for the year as trade and economic concerns grip Wall Street.
The great rate debate. A Fed official today became the first to suggest the central bank should not hike this month.
Eco-friendly fashionista. Meet the entrepreneur who's helping others turn their vision into a reality with a sustainable twist. Those stories and more tonight on Nightly Business Report for a Friday, December 7th.
And we do bid you a good evening, everybody, and welcome. Now, I know we have said this before, but this really was an exceptionally dramatic week on Wall Street, and it ended with more of the same. Stocks fell sharply again today, dogged by Wall Street's two great concerns, trade and the path of interest rates. Early in the day, the government's monthly employment report showed the economy created 155,000 jobs last month, and the unemployment rate held steady at 3.7%. And average hourly earnings rose slightly as expected. Now, many called it a Goldilocks report. Not too hot, not too cold. But it wasn't enough to draw in the buyers today. By the close, the Dow had plummeted another 558 points to 24,388. The Nasdaq dropped by 219. The S&P fell by 62. For the week, the Dow lost about 1,100 points, about 4%. In fact, all three of the major averages were down more than 4%, making this the worst week for stocks since March. Bob Pisani has more now on the rocky trading on Wall Street.
Stocks slid deeper into the red on this Friday, jolted by another bout of trade-related tremors. The Dow fell more than 600 points at session lows. But first, the November jobs report showed a little bit of softer but not necessarily weak print on the labor market. That gave investors some relief on the Federal Reserve's future rate hike path. But then it became all about trade, as it often has been. One market strategist from J.P. Morgan said the S&P 500 has lost almost 10% of its value this year due to trade and tariff uncertainty alone. That's a bold call, but it may not be far from the truth. Just look at what happened today. First, the White House economic advisor, Larry Kudlow, appeared on CNBC just after the markets opened at 9:30 a.m. Eastern Time, saying that President Donald Trump would consider extending the 90-day tariff truce if good progress was made on the talks. The Dow jumped more than 100 points in the next few minutes on that. But less than a half an hour later, White House trade advisor Peter Navarro appeared on CNN, said the U.S. would move forward with raising tariffs if China trade talks were not resolved in 90 days. So stocks, which were already off their highs, fell promptly, and they just kept dropping from there. Industrial names like Caterpillar and Boeing dropped about 3 or 4% each. Tech names also dragged down. Apple wiped out all of its gains for the year. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The Fed also took investors for a ride today after a central bank official put his foot down and argued against an interest rate hike when the Fed meets next. Our Steve Leisman has more.
A strong downdraft in stock prices combined with new worries about the economy for next year has the Fed debating publicly whether it ought to hike rates in December and how much, if at all, to hike rates in 2019. St. Louis Fed President James Bullard became the first Fed official to suggest the Fed should not hike in December and should instead push it back to January. The interest rate futures market had been putting about an 80% chance on that December hike, but came off those odds a bit on Bullard's comments. His remarks followed those from Fed Governor Lael Brainerd, who suggested the Fed should hike near term but adopt a less certain view next year, depending more on the economic data.
So the most likely path for the economy is positive, although some tailwinds that have provided a boost are fading, and we may face some cross currents. The global growth that provided a strong tailwind going into this year has moderated. Here at home, the impetus to growth from fiscal policy is likely to fade going into 2020, and after being exceptionally accommodative, financial conditions have tightened in recent months.
Over the past several weeks, the Fed has gone from being relatively confident in hiking several times next year to now suggesting that future hikes will depend on the data and the outlook.
There's a good chance that there will be a pause at some point in 2019, and we haven't had a pause. But I think that markets are, of course, pricing in a lot less tightening for next year. It's basically one hike price relative to that.
The November jobs report was weaker than expected, but 155,000 jobs created is still a strong number, and the unemployment rate stayed at a multi-decade low of 3.7%. Most Wall Street economists saw the numbers as strong enough for a December rate hike from the Fed, but weak enough that after that, the central bank probably should take a break. For Nightly Business Report, I'm Steve Leisman.
So what does our next guest feel about Fed rate hikes in the future? Joining us right now is Joe Davis. He's Global Chief Economist at Vanguard. So, Joe, you have one Fed official who says, okay, raise rates this month, but then pause after that. And then another official out today saying you should not even raise rates this month. What do you think?
Well, I certainly don't think the Federal Reserve will pause and skip the meeting in just in short order. I think that actually would be somewhat of alarming, because I think it would give a signal that perhaps the Fed knows even more than the markets do, which are already skittish and certainly underperforming. Our view has been for some time, I mean, going back more than 2 years, that the Federal Reserve would be hard pressed to get Fed rates above 3%, which meant only 2 hikes into 2019. So eventually we were going to come to this debate by the Federal Reserve. We just seem to be approaching it even before 2019.
So why do you think the market is responding as vehemently as it seems to be to the comments that we've heard this week from various Fed officials and others suggesting that the economy is slowing down at the rate at which the Fed should reconsider some of those rates?
Well, I think there's a number of forces. Clearly, the trade uncertainty is one factor, which already was going to lead to the market volatility that we had. Secondly, is the global slowdown. It's one of the themes of our outlook even for 2019, and I think we will start to see weakness in the U.S. data. And then thirdly has just been, I think, this natural discourse that was going to occur. The Federal Reserve has been a little bit more aggressive in their view for the Fed path than the bond market. Now, the Fed looked to be right for 2019 in the bond market's mind just as short as 2 months ago, but we were of the view that the natural rate was lower and hence the Fed wouldn't get as far. And so I think all these three forces are coming together at the same time, that the market was already, certainly not fairly valued. And so that is, I think, all coming to a head at the present time.
Jerome Powell a couple of weeks ago kind of started this all off by saying he felt like we were closer to neutral than previously thought. What is neutral for you in terms of an interest rate, a short-term interest rate here, that the economy can withstand? It doesn't hurt growth, but it doesn't impede growth at the same time.
Sure, it's that missing variable that everyone wishes we knew with precision.
What do you think it is right now?
But no one truly knows. I think we're close to it. I mean, our mind has been roughly 2.5% with a range. I mean, that's the same concept with full employment. You don't really know until you've gone well beyond it. So now, if we're right that the Fed is close to pausing 2019, clearly they will. In fact, we think they will stop by June. That means that the most cyclically sensitive sectors of the economy should have already started to slow. Housing is a good example. Right. And so we should see some modest weakness in the labor market. And so I think we're starting to see that. I think it is premature, though, to start talking about the Fed not raising rates this month.
Very good. Joe, good to see you. Joe Davis with Vanguard joining us tonight.
Thank you. Thank you.
And now to oil, where a deal to cut production was reached by OPEC and Russia after a one-day delay. That deal was bolder than most had thought, sending the price of domestic crude higher. Brian Sullivan reports for us tonight from Vienna.
Well, here in Vienna, in the end, OPEC not only delivered on a production cut, but a bigger production cut that many had originally expected, and the market responded with oil rising a few percent. In the end, OPEC cut production by 1.2 million barrels a day. However, it is not just the absolute number, it is what they are cutting that off of. And the Saudis and others surprised the market by saying they would cut that from October production levels, which were lower than November. Therefore, it was actually a larger cut than many initially expected. Now, all day long, the rumors were flying about what they might do, but about halfway through the day, the Iranian oil minister left the meeting early. Can you confirm the 1.2 million barrel a day cut overall?
Yes, this is please 800 agreed, but for another 400 from non-OPEC.
And will the word exemption
discussing, and I am sure that they will reach agreement.
Is Iran a part of the cuts?
No, Iran is exempt.
800,000 from OPEC members, 400,000 from non-OPEC, which is a majority of Russia. And in the end, it was Russia's participation in today's meeting which really changed the game. OPEC is fighting a world where U.S. oil production is now the biggest in the world. And so Russia sort of joining with OPEC has created a new dynamic. In fact, we had a chance to speak with the energy minister for the United Arab Emirates, and I asked him, in an American shale oil boom world, does OPEC still have power?
Of course, OPEC and non-OPEC. It's not only, this is not an OPEC decision alone. We cannot do it without the non-OPEC. This is a group of producers who cares about consumers as well as their own countries.
So OPEC is still powerful, but with Russia, they are there to counter the huge U.S. oil juggernaut, which has really come out of nowhere and doubled production in less than 1 decade. So in the end, we're seeing oil prices rise. OPEC gets a production cut deal, and the price of gasoline will probably also be on the rise in the near term. For Nightly Business Report, I'm Brian Sullivan, Vienna, Austria.
Elsewhere, as we have reported, the arrest of a Huawei executive has added to tensions between the United States and China. And today, the Chinese telecom giant's chief financial officer appeared in a Canadian court for a bail hearing where prosecutors said the United States wants to charge her with fraud, alleging that her company continued to do business with Iran despite the sanctions imposed on that country. This is a very delicate moment for the world's two largest economies. And as Eunice Yoon reports, the Huawei CFO's arrest is not going over well in Beijing.
Chinese telecoms gear maker Huawei is putting on a brave face after its CFO, Meng Wanzhou, was arrested by Canadian authorities. With Meng away, Huawei has designated its chairman, Liang Hua, as acting CFO. Liang was CFO before Meng. Huawei is also trying to reassure its suppliers that the arrest isn't going to have a big impact on its business. In a letter to its global suppliers, Huawei said the U.S. move was, quote, against the spirit of free economy and fair competition, and went on to say, regardless of how unreasonable the U.S.'s approach becomes, the partnerships we have with our global suppliers will stay unchanged. What happens to Meng could complicate trade negotiations between the U.S. and China. Officially, the Chinese government isn't directly linking Meng's arrest to the trade talks, but unofficially, the state media is arguing that it's a political decision and a way to stifle Huawei and China's tech ambitions. White House officials, though, say President Trump wasn't aware of the arrest before his negotiations with President Xi. Separately, there are reports that Japan is now considering restrictions for gear made by Huawei and ZTE. Government officials say that a meeting to discuss the matter further could take place as early as Monday. For Nightly Business Report, I'm Eunice Yoon in Beijing.
It is time to take a look at some of today's upgrades and downgrades. Tesla was upgraded to buy from hold at Jefferies. The analyst says the electric car maker has demonstrated its profit potential. The price target is $450. The shares fell, though, in more than 1% to $357.97. Morgan Stanley joins the chorus of analysts cutting their price targets on Apple. Morgan Stanley lowered its target to $236 a share. The analyst cites weakness in the Chinese market. The firm maintains, though, its overweight rating on the stock. The shares fell 3.5% to $168.49.
Still ahead, looking for stocks that will grow earnings in any type of economy? Our market monitor has some ideas.
Sentiment among CEOs declined for the third straight quarter, although it remains at historically high levels. According to the latest survey from the Business Roundtable, confidence overall remains strong, but the survey does show a decline in expectations for capital investment, hiring, and sales. A separate gauge of consumer sentiment shows that Americans continue to feel good about their economic prospects, in part because of the strong job market.
Speaking of which, the tight labor market may be good for workers, but it is creating challenges for employers. It's no secret that many companies, big and small, are still having a hard time finding workers. Kate Rogers went to Horse Cave, Kentucky to see what one business owner is doing about it.
Check the viscosity of our product.
At T. Marzetti, supply chain workers like Joshua Ash are crucial. Ash works in quality assurance at the company, which owns salad dressing maker Marzetti, bread company Sister Schubert's, and supplies sauces to food companies like Chick-fil-A and Buffalo Wild Wings. He's moved up the chain in the past 11 years, now working as a supervisor with a team of 17.
We get about 500 ingredients in this plant. We make about 300 different products. So every day I'm going to see something different.
Companies like Team Marzetti are looking to beef up their supply chain teams nationwide, which can prove challenging in an increasingly tight labor market. These are careers with competitive wages that can reach into the six figures depending on the role and experience that workers have, but sometimes that's not enough. A 2017 study says a worker shortage may turn into a full-fledged crisis in the near future, with as many as 6 open positions for each available worker.
You can no longer post and pray and expect to get plenty of qualified applicants coming through. You have to go out and poach and hunt talent, and that's exactly what we do as an executive search firm.
At Team Marzetti, some 2,800 people work in the supply chain, and the company is looking to hire an additional 300 workers across the country in roles that range from engineering to quality assurance and even customer service.
Some of our bigger labor challengers are filling the more skilled maintenance type positions. And what we've found is you really have to pay. You have to pay the market price to get good talent. Then you got to, in order to keep them, you really have to make sure you have, ongoing training.
The company is also retraining some of its workers as it moves to automate repetitive parts of the supply chain.
If you take care of your people, you involve them in your operation, let them be part of the problem solving, and they want to be here. They want to be here.
For Nightly Business Report, I'm Kate Rogers in Horse Cave, Kentucky.
A big decline for shares of Big Lots, and that's where we begin tonight's market focus. The discount retailer reported a wider than expected loss. The company also lowered its outlook. It attributed part of its loss to trade tensions and higher distribution and freight costs. The shares plunged 23% to $31 even. The cigarette maker Altria made its investment in cannabis producer Cronos official. Altria is taking up to a 45% stake in Cronos, valued at nearly $2 billion, with an option to increase it to 55%. As we told you, Altria is also reportedly in talks to take a minority stake in the e-cigarette maker Juul. Shares of Altria were off a fraction, while Cronos Group soared 21% to $12.72.
IBM late yesterday struck a deal to sell some software assets to an India-based software company for nearly $2 billion. The sale is all part of IBM's efforts to de-emphasize its legacy businesses. The stock fell more than 3% during this sell-off to $119.34. Also late yesterday, Chevron said that it plans to spend $20 billion on capital projects in 2020. This would amount to the energy company's first year-over-year capital spending increase in 4 years. Shares were down a fraction to $115.49. And late today, Facebook's board approved a $9 billion increase in its share buyback program, adding to the $15 billion it had previously authorized. The repurchase program does not have an expiration date either. Shares rose in initial after-hours trading after falling 1.5% during the regular session.
It is time now for our weekly market monitor, who is betting on companies he says are poised for earnings growth over the next 3 years. Joining us tonight, Charles Bobrinskoy. He's the vice chairman at Ariel Investments. Charlie, it's good to see you again. Welcome back. What a week to have you here.
Yeah, thanks. I wish you'd have me on a better week, but I'm happy to.
Well, actually, you have some picks that probably will weather most market storms, if I'm reading your notes correctly here, and Blackstone is one of them. Why do you like it?
Well, what is going on in the market right now is people are afraid that we could be going into a recession, and they're punishing stocks that don't tend to trade well when the market is soft. And Blackstone does invest in a lot of leveraged buyouts, real estate, private investments, and those things will lose value if the markets go down. So the market has gotten very scared, and it's punished companies like Blackstone who are market sensitive. But the good news is Blackstone's business is wonderful. People are investing in leveraged buyouts. Big universities are sending money to real estate funds. Right. And Blackstone has more money under management than it's ever had before.
Borg Warner, of course, auto components and parts and things. I guess you're going to tell me that they've been punished by the tariff situation. It's going to get better, though, you think?
It's not so much the tariffs, Bill. It's that people are worried that we're going to have a downturn in the automotive industry, that We've had a peak here and that people are going to be building less cars. And when they build cars, they're going to start being electric cars. And we think just both of those things are exaggerated. People are going to be buying gas-powered cars for a long time. Electric isn't going to reach 20%, in our opinion, for 15 years or more. So people are still going to buy gas-powered powertrains and turbochargers, which is what Borg-Warner is so good at.
And we finish up with CBS Corporation. You're focusing on some really good earnings growth.
Yeah, I mean, people are very negative on traditional media. Everybody they think is going to watch Netflix and other over-the-top TV shows. But CBS has a wonderful library of programming, the sports that are on CBS, including the NFL. And then the political advertising has just been spectacular. Every 2 years, people spend more and more and more money on political ads, and they tend to go to those CBS, NBC, ABC broadcast companies.
On that note, Charlie, thanks so much for joining us.
Thanks for having me.
Charlie Bobrinskoy with Ariel Investments. Coming up, going green and making green. One entrepreneur who did it the hard way had the bright idea to share what she learned.
Back in 2016, Newsweek reported that Americans doubled the amount of clothing they toss out each year, from 7 to 14 million pounds. And that's why brands like Walmart and Gucci are working on sustainable fashions, versatile enough to be worn more often, and they're made in environmental and sustainable ways. But startups interested in attacking this problem found it difficult to find affordable materials and manufacturing, until one Boston entrepreneur got the bright idea to show them how.
This is our new blazer.
Cara Bartlett's clothing line, Veda, is moving into a third office in 3 years,
And now this space is almost triple.
a sure sign of growth. Her multi-use pieces, zip-out sleeves turn this blazer into a vest, for example, are ethically made and sustainably sourced. That is, her domestic manufacturers pay their employees a living wage, and that's surplus fabric that she bought from another company.
If you launched this type of company 10 years ago, I think it would have bombed.
She credits Shannon Lohr's Factory 45 for making it work. That's a 6-month online crash course on sourcing materials, manufacturing, and raising capital ethically and sustainably.
I was a fast fashion bargain bin junkie in college. Like, I wanted the deal. I was known for wearing a dress once, throwing it in my closet, never looking at it again.
But her attitude changed while traveling after college, when she learned how waste impacts the world, prompting Lohr and a business partner to create the Versalette, one piece that could be worn 15 or more different ways. But sourcing materials and finding a manufacturer took them a year and a half. Raising money on Kickstarter was the easy part.
We set a goal of $20,000, and we ended up tripling our goal and becoming the highest funded fashion project in Kickstarter history at that time.
The Versalette was profitable from the get-go. But Lohr wasn't in it for the long haul. Instead, she began to share what she'd learned.
There were so many people out there who wanted to start clothing companies. They were even interested in sustainability and, ethical manufacturing, but they didn't know where to start.
Lohr started offering classes in 2014, then she moved online. This year, 120 designers are paying $500 a month for Factory 45, giving them access to Lohr's invaluable and growing database of suppliers and manufacturers. This manufacturer in Fall River, Massachusetts, works with Lohr's husband. His company, called Project Repat, turns old T-shirts into quilts. Ross Lohr says they're on track to sell $10 million worth of quilts in 2018. New Yorker Mary Bemis dreams of numbers like that. She's an advertising data analyst by day, but Factory 45 helped her launch Reprise Activewear this fall.
I knew sort of like the broad steps of I need to find a fabric, someone will need to sew it for me, I'll need to distribute it, I'll need to raise money, but how to do any of that I had no idea.
Her workout gear is made of Tencel. It grows on eucalyptus trees. There's no polyester.
It's naturally cooling, it's sweat wicking, it's antibacterial.
Priced to compete with Nike and Lululemon, the leggings are $109. She sold about 300 pieces in just 2 months. The printer she found in Brooklyn offers water-based ink. It costs more, but owner Jose Andrade says there is growing demand for it.
It's more prevalent, more like in our face in the past 2 years, and I think that's kind of like the future for us right now.
You can wear it open or closed.
And that's the type of future that Shannon Lohr is betting on.
This growth is just amazing.
Well, I mean, organic food is now a $50 billion a year industry, so who knows? By the way, Shannon Lohr just opened a new section on her website called Market 45, where her clients can showcase their greener brands as they try to bring a different type of thinking to the fashion industry.
All right, take a deep breath. Before we go, here's a look at the day on Wall Street. The Dow fell 558 points. The Nasdaq dropped 219. The S&P 500 fell 62. For the week, the Dow lost about 1,100 points, and the major indexes all fell more than 4%, making it the worst week for stocks since March.
And we still have the Federal Reserve meeting to go, and the trade talks.
So tune in again next week, because that'll do it for Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great weekend, everybody. We'll see you Monday.